Good part of the day, dear subscribers and dear everyone who is preparing for F9 examination for June and for later examinations. With my classes here, offline classes, we started F9 at the beginning of April and we're going to finish the whole syllabus in just 4 days from now. So a month for the syllabus and another month for the monster practice. But today, just to refresh the knowledge of my students, I've decided to give them a quick revision, like mini practice, consisting of 8 questions. And I gave them 20 minutes. Of course, they could not complete it in 20 minutes, but let it be. I also opened up my Instagram channel. Currently, there is almost nothing there, but soon it will be filled up with my own experiences, experience sharing, and other recommendations, suggestions, and everything that I can do to help people to ace their ACCA path in the quickest time possible. So please subscribe it if you can. Okay, let's get started. In the first question, we're asked to find the IRR, internal rate of return of this project. So we're told that for discount rate of 10%, it's the NPV is $50. But if increased by 1%, which means if the discount rate is now 11%, it becomes 30. I mean, the NPV decreased by $20. So if we're given 2 discount rates and 2 NPV figures, calculating IRR is a piece of cake using this IRR interpolation method, which goes the lower discount rate, which is 10%, plus NPV for the lower discount rate, $50, divided by NPV of the lower discount rate, 50, less NPV for the higher discount rate. Like higher discount rate is 11%, so our NPV is going to be $30. And this is multiplied by the difference between 2 discount rates, 11 minus 10. So I came up with 12.5%, which is the IRR. That means at the discount rate of 12.5%, our project is going to give us nothing, like 0 NPV. Okay. For the second question, we're asked to find, I always start the question with the requirement. So we're required to find the present value of the cash flow in the second year. Okay, reading the what's given in the task, we found out that tax is 30%, but payable after 1 year in the following year. So 30% of like tax for the first year is paid in the second year. Tax allowable depreciation, which is a cash saving, 25%. Will be claimed each year. That means tax allowable depreciation of the first year is calculated in the first year. So to come up with the present value of year 2, I should come up with tax allowable depreciation of year 2. From year 1, the asset is $100,000. So depreciation 25%. So depreciation for year 1 is going to be $25,000. So because it is a reducing balance, for the depreciation of year 2, we subtract it from the initial cost. So $100,000 less $25,000, and then multiplied by the depreciation rate, 25%. So for year 2, our depreciation charge is going to be $18,750. But because it is tax allowable, we multiply by the tax rate, which is 30%. So we're paying $18,750, but then we're getting tax incentive, or what is the tax deduction of 30% of this amount, which is $5,625. So this is like cash savings, and we can treat it like cash inflow. So if we also look at this, it says that $20,000 annual cash inflow. Okay, it's going to be the same in year 2 as well. So for year 2, cash inflow $20,000 less tax because it reduced the amount inflow. And then we add back tax allowable depreciation because this is the cash inflow. As I said, we treat this cash saving as cash inflow. So we come up with 19,625, which is the future value of year 2. But because we were asked the present value, we need to discount it back to today. So discount rate is 8%. So from the present value table, find the 8% for year 2, and then this is a rate. We multiply the future value to come up with the present value, which is 16.825. But be very careful because in the question we are asked, give your answer to the nearest $100. So if you write 16,825, you're going to get incorrect because this is not rounded. So the rounded version is going to be 16,800. This is going to be the correct answer. So be careful with the wording of the task. For the third, we're asked about the sensitivity of the project. Sensitivity is found by the NPV divided by the variable, whatever it is asked. So in this task, sensitivity of the project to the cash inflow. Okay. First, we should come up with NPV. Initial investment is the expense, so it's in brackets. Cash inflow is the profit, so it's not in brackets. Cash outflow is another expense, so it should also be in brackets. NPV is found by the $600,000 less initial investment and cash outflow. So our NPV is going to be $200,000. We found it. And then present value of cash inflows. So present value is automatically given here as $600,000. So the task is easy now. NPV 200 divided by the present value of cash inflow 600. When we multiply by 100%, we get the 33% answer. And the meaning behind this answer is as follows. If our cash inflows are going to be lower by 33%, then our project is going to give us 0 net present value. Okay, for this task, equivalent annual cost. The task says that replacing the vehicle every 2 years. That's why we can ignore this year 3 values. And also, resale value of year 1 can be ignored as well, because we are replacing not every year, but every 2 years. The task is as follows. Equivalent annual cost is found by the present value of costs divided by annuity factor of that year. If, for example, we are replacing every 2 years, it should be annuity of 2 years. If 3 years, like every 3 years, then it should be annuity factor for 3 years. So the vehicle costs $25,000, which is in years, like in time 0 now. So discount factor is also 1. In year 1, we are not replacing it, but we need to pay this operating cost. We need to run this. So 5,000 cost in brackets, and discount factor is like for 6% in year 1 is as follows. And in year 2, as you can see, I haven't used 8,000 or 15,000. I used 7,000. How? In year 2, 8,000 is operating cost, but we could sell it for 15,000. So I got the net 8,000 minus 15,000 plus, which comes up with 7,000 net plus. So I use this for value. And 0.89 is the discount factor for 6% in year 2. When we multiply the cash flows by respective discounting factors, we come up with the following values. And the overall present value is going to be 23,485. But this is not equivalent net annual cost. This is the cost for 2 years. So to come up with annual cost, we should divide this value by annuity factor of 2 years. So 183.3 is going to be annuity factor for 2 years at 6%. So the answer is 12,812. B. The fifth one, a very straightforward question, right? Theoretical X right price, or TERP as we say it. Here, if we read the task, it says that for every 4 shares, existing shares, you get 1 rights issue. So we should find the share price just before the rights issue. So it fell by 40 cents to 220, but then we don't get this figure. We get the price per share just prior to rights issue. We need this price. So for every 4 shares, worth 2.45 each, is going to be 9.8. We get 1 share rights issue at 1.45. So overall, for when we add this, for $11.25, we're getting 5 shares. So price per share is going to be 11.25 divided by 5, $2.25 per share after the rights issue. This is a theoretical question now. According to Modigliani and Miller, in a perfect capital market, shareholders are indifferent between dividend and capital gains. And this is true because in capital markets, shareholders could gain, for example, could receive annual dividends, or they don't receive dividends, but they can let the company invest in good NPV projects. So as a result, companies' share values, the price of share will increase, and this is another gain for shareholders. They may not receive the profits dividends right now, but after some time, they will gain because of higher price per share. So this is true. And secondly, residual theory states that dividends should be paid ahead of investing in positive NPVs. No. For residual theory means the remainder theory. Firstly, we invest in positive NPV projects, and then what's left, if any, we can distribute it to dividends. So not ahead, but after. So it should be false. So the 3 questions, like statements, are about Islamic finance. Sukuk holders have little influence over the actions of Sukuk manager. That's incorrect because in traditional bond holders, this is true. But in Islamic finance, Sukuk holders have close relationship and close influence on the actions of the Sukuk manager. They even share the risks. So this is false. Second, under Musharaka contract, profits are shared between partners and according to ratios in the contract. This is exactly true because Musharaka means partnership, actually. An Ijara transaction is the Islamic equivalent of lease. Exactly. Ijara is the equivalent version of traditional leasing. So the 2 are true, and the first statement is incorrect. And the last question here, it's about the expected values. What is the expected net present value for the product? Okay, we have the initial outlay, which is $20,000, but for 3 years, we don't have single cash inflows. We have 3 of them. So what we do is to look, if $10,000 has a probability of 0.2, which means getting cash inflow of 10,000, the probability, the chance is 20%. And there's a 50% chance of getting 7,000 and another 30% of getting 6,400. So we come up with the single expected value by multiplying the cash inflows by their respective probabilities. 10,000 by 0.2, 7,000 by 0.5, and 6,400 multiplied by 0.3. Overall, In year 1, we're expecting 7,420. The same steps have been done for year 2 and year 3. So at the end, we now come up with traditional NPV calculation with $20,000 investment required today in time 0. And in the first year, our expected value is 7.420 as we came up here. In year 2, year 3 is also given. At the cost of capital 10%, you can write down the discount factors, and then we multiply it by discount factors to come up with the present value of cash flows. So it's 20,000 because in year 0, in time 0, discount factor is always 1. And these are divided by their respective discount factors from the present value table, which you can find in the question booklet, or if you're taking CBE, there is the formula sheet provided. So our NPV is the sum of all of these present values. So as we can see, cash inflows are actually less than the cash outflow by $582 minus. So that's why it's in brackets. So this is the answer, A.